Hey guys, welcome back to the Click Capital channel, and today I've got a real interesting video for you where I'm going to show you a quick and easy tutorial on how to use a free online tool that will not only help you decrease portfolio volatility, but can also help decrease your drawdowns and increase the consistency in your portfolio as well. The percentage of up months and the percentage of up years, making for easier investing. So if you're into trading and investing in stocks, you'll find this really valuable, and make sure you stay to the end of this video. I'm going to share with you what stock I'll be buying in my account tomorrow when the market opens. I've just finished my weekly stock research, and as part of my new stock pick service, I'll be buying this small cap stock tomorrow. So I'm going to go over that. I'm also going to go over a few questions I received after yesterday's video about the new service, as well as revealing the pricing. So if you're interested in hearing more about my new stock pick service, then make sure you stay to the end of this video as well. Now let's dive right into this tutorial, and I'll explain to you how you can use what I call IPC to measure the diversification of your portfolio and how you can make it more diversified to lower your volatility. So first off, I find the subject of portfolio construction, diversification, and minimizing volatility both challenging and fascinating at the same time. And so a while back, I looked for new ways to increase the diversification of my portfolio in order to lower the volatility, lower the drawdowns, and increase the consistency of returns. And so I came up with something I call interportfolio correlation, or IPC, which is a unique way to measure how all your assets are correlated with the rest of your portfolio. And I haven't really seen anybody else talk about this. I know in quantitative finance and quant funds, they'll use advanced statistical measures like beta coefficient, autocorrelation, pairwise correlation, things like that. However, I'm going to keep it really simple here and show you the way I do it and how anybody else can easily do it right now using a free online tool and a simple Google sheet. So stick with me and I'll run you all the way through it. It's really not that hard, and you don't need to be a math whiz or have any programming or coding skills either. But before I show you how it works, let's just talk a little bit about why should we use interportfolio correlation. Well, in my opinion, there really isn't a secret to investing, but if there were, I would say it's staying in the game. And the way to do that is by consistently applying a simple strategy over time and avoiding catastrophic losses. So IPC can help lower your portfolio volatility, lower your drawdowns, and increase your consistency, helping to keep you in the game with a smoother ride and less stress, which I think a lot of people underestimate and is very important for successful long-term investing. Shouldn't be a hugely stressful endeavor. Otherwise, that's hard to stick to. So let's dive right in. How does IPC work? So first off, you've got to enter your stocks into this free tool I'm about to show you. Just want to copy and paste the data into a spreadsheet. I'll show you how to do some simple calculations, and then we can look at the individual asset IPC scores and your total portfolio IPC score. Okay, so to do this, we can use a great free tool over at the website portfoliovisualizer.com. Then you just want to come up to their tools and scroll down to asset correlations and click on that one. You're going to come to a screen like this. So as an example, I'll use my current open picks in my new stock pick service, and we're just going to type in the tickers. That's Palantir, Crocs, and GigaCloud Technology. And we'll just leave it at the default measurement, looking at monthly returns over the last 36 months, the last 3 years, which is a good amount of data, few different market cycles, dozen earnings results from all the companies, and should give us a good idea of how closely they move with one another. So we'll go ahead and click on view correlation, and then we can see here what the correlations are against each other. So Palantir has a -3% correlation with Crocs, which is good, meaning they're a little bit negatively correlated. They go in the opposite direction, whereas Palantir and GigaCloud have a 10% positive correlation. And so to work out the IPC of each stock in your portfolio and the total IPC of your portfolio, you just want to come and highlight all that data inside the table. Click on Control-C, copy, go into a Google spreadsheet or an Excel spreadsheet or whatever other spreadsheet program you use. You want to paste that in there. Then you want to go ahead and delete the ones. And then with the remaining numbers, you want to type in the formula equals sum bracket, highlight the 3 cells, close it off with another bracket, divide by 2, because there's 2 different numbers. Then you want to highlight that cell and drag it across. And so that's the IPC for each stock. Palantir, positive 3.5%, Crocs, positive 4%, GigaCloud, positive 10%. And then to work out the portfolio IPC, again, we'll just do another formula equals sum, grab those 3 values, close it off, divided by 3. And so the portfolio IPC, even though this is really a small portfolio right now with 3 stocks, the portfolio IPC is 6%, which is really good. The closer to 0, the better. So for example, if you were holding large cap growth fund, Apple, S&P 500, your IPC is probably closer to 90%, meaning it's not really diversified at all. So ideally, you want to have a portfolio where each asset on average has a low interportfolio correlation with the rest of your assets, creating for a portfolio IPC That is low. The lower the better. And there's a big difference between a 0.8 and a 0.6, 80% or 60% portfolio IPC. I try and keep mine under 50. But like I said, the closer to zero, the better. And so just giving you another example of how combining uncorrelated assets together makes for a much more smoother ride, lower drawdowns, consistent returns, less stress for you, and keeps you in the game. Let's just go through a hypothetical. And let's say there was one really lucky investor out there 10 years ago, a true market savant, who happened to invest in Bitcoin. So let's just look at a portfolio with 100% in Bitcoin and how that's done over the last 10 years. Of course, it's been a huge annualized return. But look at that drawdown, 73%. Very few people in this world can withstand a 73% drawdown in their portfolio, especially when it's a significant amount of your net wealth invested. Even though Bitcoin has been the best performing asset class the last decade by far, still gave a really good Sharpe ratio of 106. But like I said, that drawdown is brutal, and very few people in this world can stomach volatility like that. So let's say our market savant was an absolute visionary, and 10 years ago, he also decided to diversify his portfolio, putting half and half in Bitcoin and Nvidia. Let's take a look at what the returns and drawdowns would have looked like over the last 10 years with that dream portfolio. Annualized return actually improved, and the drawdown lowered as well to 64%, with the Sharpe ratio increasing significantly to 1.46%. However, let's say our market savant didn't want these huge drawdowns. Didn't want to see his $1 million account go down to $300,000 one year. Doesn't need all that stress in his life. And he understands that energy stocks have the lowest long-term correlation to the rest of the market. So he goes ahead and adds the energy sector fund ETF into his portfolio and equal weights it with Bitcoin and Nvidia. Let's take a look at the returns over the last 10 years. Annualized returns didn't come down much at all, still above 100%. Drawdown significantly been reduced from 64% to 40%. It's over a third lower, and the Sharpe ratio improved again. Let's take it a step further, and our market savant realizes gold has really low correlation to other asset classes, and again, equal weights the portfolio in all four of these assets. Taking a look at the historical returns, annualized return came down, but not by much. Drawdown, once again, significantly reduced to a much more manageable 29%, while the Sharpe ratio remained really high at 1.56. And there's a look at the equity curve of that combined portfolio. Quarter Bitcoin, quarter Nvidia, quarter energy stock sector fund, and a quarter in gold. Much more smoother than just being in any one single asset, and smoothens out the yearly returns as well. And again, looking at the asset correlations between those four assets, we can see the average inter-portfolio correlation, IPC, for each asset is really low. Bitcoin and Nvidia 20% positively correlated, but like I said, energy stocks can have really low correlation against other parts of the market. Risk on growth assets, negative 15% with Nvidia, and gold as well. Got a negative correlation with Nvidia. And I'll just quickly show you what the portfolio IPC is on this. And I've gone ahead and quickly worked it out. That portfolio total IPC came in 0.08. So 8% positive correlation, which is really low, a really good IPC score. Like I said, ideally, you want to get it under 0.5, closer to zero, the better. If it was bang on zero, that means on average, all your assets pretty much have no correlation, positive or negative, with each other. And so in theory, you should have lower volatility, lower drawdowns, and a higher percentage of up months and up years. That is, of course, if you're holding good assets. If you're holding a bunch of assets that are all going down, then no amount of low IPC can save you. So in my opinion, there's three main keys to successful investing. The first being dollar cost averaging, practice of regularly adding money into your portfolio, whether that's weekly or monthly, really does make for a smoother ride and really accelerates the compounding machine that a good portfolio can be. As I've just showed, remaining diversified along with dollar cost averaging, in my opinion, is the only two free lunches when it comes to investing. So you want to have many different risk exposures in a portfolio combined together, and using a technique like IPC to measure that. And lastly, I think a lot of people underestimate this, is staying mostly long only. A shorting is notoriously difficult, should only really be done in the short medium term, tactically, with a small amount of funds. All my retirement and personal portfolios are long only, and there's structural reasons why being long only is going to be a lot more likely to be successful. With the first reason being that stocks over time are head and shoulders the best performing asset class versus other asset classes like bonds, T-bills, gold. And if you keep your wealth in fiat currency savings, you've actually always got the wind in your face of inflation, especially these last couple of years. And so stocks increase over time because just think about what a stock is. It's little pieces of a business. You get to share in that profits. Whereas bonds, you're loaning people money, just getting a fixed interest repayment. And gold, as good as a hedge as it is, doesn't yield anything at the end of the day, just does a better job than inflation over time. And so stocks with the increase in population, increase in productivity, new technologies, and a big one a lot of people don't realize, retained earnings. Just a real simple example. Say a stock has a book value of $1 per share. They make 10 cents per year in earnings. Even without any growth, that book value could still grow by 10 cents a year. Or if they paid a dividend, maybe it grows by 5 cents a year, and the value of the business keeps increasing, even if profits weren't being increased. However, when you add an increase in profits, that's how stocks and businesses become more valuable over time. You're increasing your profits, and you got those retained earnings to invest as well. Creates like a snowball. Not only that, you've got companies buying back their own shares. Just about everyone's retirement fund around the world constantly buying new shares. You've got the Federal Reserve backstopping markets like never before. Companies constantly trying to squeeze their stock price higher. And at the end of the day, with shorting, you can't make more than 100%. If you short a stock at $100 a share, it can't go below zero. So you can only make 100%, and your short position actually decreases in size as you get closer to that point. Whereas there's no limit on how high a stock can go. You can make 200%, 300%, 500%. So for all those reasons, shorting is very difficult. It's why most fail at it. And I understand with hedging, options, puts, it's just like any insurance. Yeah, you can negate that risk. However, in the long run, you'll end up paying in premiums to insure yourself against that risk. But looking underneath the hood of stocks, the returns get even better when investing in small caps. Over the long term, smaller stocks outperform larger stocks because there's just more room to grow. Take, for example, Apple. Very unlikely it's going to go up tenfold in the next 3 years, 1,000%. However, a stock with a market cap, 200-300 million, definitely has a better chance if it's a good quality growing stock. Step further again is small cap value. Again, over the long term, significantly outperforms small caps and large caps. And that's even been the case over the last 20 years, even though large caps been on a historic long run since 2009, low interest rate era. Small cap value, looking back 20 years, is still outperformed, and we could be setting up for even more outperformance than long-term historical norms, given the current setup and huge value gap between small cap value and large cap growth stocks looking back in history. When we reach this valuation gap in the earnings yield spread, the following 10-year period, small cap value returned 16.8% year more than large cap growth. So in my new stock picks portfolio, I'm going to have a strong tilt to small cap value, as I think it has the potential to significantly outperform over the coming years, along with some other areas of the market as well. And I'll share with you guys today the stock I'll be buying tomorrow in my new trading account for the Stock Picks service. I've finished my research this week, and I've decided on Cactus, which is a small cap company in the oil services and equipment business. And this is a look at their website. They manufacture equipment for onshore and offshore oil and gas drilling. Got a comprehensive range of products, geographically diversified as well across the states. It's a well-run business with growing revenue and profits, a low amount of debt. They've beat on their last 2 quarterly earnings results. My fundamental indicators overall like it. Got some stock price momentum. And going back and looking at portfolio correlation, I had been looking at a few stocks in my narrowed down shortlist for this week. And so part of my final process of choosing the stock each week is doing an IPC test on my final shortlist, as I start with quantitative screens, then do a bit of qualitative analysis as well, looking at the fundamentals, the industry, and lots of things. Insider transactions, the website, their last earnings results, analyst expectations. Along with my fundamental indicators and technical analysis, I use IPC, and we can see Cactus comes in really good. Negative 17% correlation with Palantir, 10% positive with Crocs, negative 5% with GigaCloud. With its inter-portfolio correlation IPC score against the other 3 stocks in the portfolio coming in really good, minus 4%. Taking my overall portfolio IPC, almost bang on zero, 1% positive correlation, just about as good as you'll see. So this is my current stock picks portfolio. Like I said, I'll be acting Cactus tomorrow at a random time in there. And so in this tutorial, I just wanted to show you a real life example of how you can use my IPC measure to increase the diversification in your portfolio, which should decrease volatility and increase consistency, making for a smoother ride. And just to give you a visual again on what dollar cost averaging can do, going back to our example portfolio, and I know this is all hindsight, of course, adding Bitcoin and Nvidia in there. This is just an example of combining different assets, 2 that have performed really well and another 2 with lower correlation, how it can decrease the drawdown. However, let me show you what dollar cost averaging does to this really good performing portfolio over the last 10 years. So hypothetically, back in late 2014. It started with $10,000, did super well, finished up at $940,000. However, if we go back and edit this portfolio in settings and we contribute a fixed amount, say $2,000 every month, and then we go back and annualize the portfolio, that $940,000, not only do we get a lower drawdown because of consistent contributions, however, the final amount goes up to a whopping $6.3 million from just contributing $2,000 a month. And look at that equity curve, much more smoother as well, much more easier ride. So that just shows the power of having a diversified portfolio with uncorrelated assets and regularly contributing fixed amounts, ideally increasing every year as well, how it can create an amazingly smooth portfolio equity curve if you do have at least a few winning assets in there, of course. So I know we hear it all the time, and it sounds so simple, but diversification really is important. And using IPC, that's a statistical measure of diversification in your portfolio, because if you're not well diversified, it's just a matter of time before you're going to have a really large drawdown. And again, the key to successful investing is staying in the game. You'll find that in a lot of games and sports, the player who makes the least mistakes wins. Or like in poker, the best player is inexploitable. He's not predictable. Doesn't make huge mistakes, and he can't be taken out of the game. So think of investing like that as well. And so even though different strategies and portfolios can take you to the same end result, ideally you want a smoother ride getting there. And in my opinion, for most people, you want to try and keep your maximum drawdowns under 40%. Once you start approaching 50%, seeing a $10,000 account go down to $5,000, 100 going down to 50, a million going down to 500, that's psychologically hard. Even if you stick with it, you could be under some stress. And just speaking numbers as well, when you take big losses, big drawdowns, just an exponential bounce back is needed to hit that high watermark again. So stay invested, regularly contribute, try to create the smoothest, less stressful ride for yourself as possible. And it isn't just about keeping a diversified portfolio and regularly investing. You've also got to have the temperament. Like Buffett says, it's not the smartest guy that wins in the markets, the guy that can stay calm, stay disciplined and committed. Because financial markets are like a roller coaster. You've got to accept the ride's going to be bumpy, and to earn that excess premium return, especially investing in things like small cap value stocks, you got to be able to put up with the volatility. But in my opinion, volatility and short-term underperformance, that's the currency you pay for long-term outperformance. And of course, it's a lot easier said than done, because when markets are selling off hard or even crashing, the news everywhere is negative. You're seeing your account go down every day that you shouldn't be looking at every day, but you do anyway. I mean, that becomes psychologically hard. And especially these days, you just have one bad day, click that sell button, and you've ended up selling at the lows. So you've got to really take a long-term outlook and expect to have those drawdowns, so they're not so surprising when they do come along. And most importantly, just stay the course, knowing over the long term, stocks do outperform every other asset class. So launching on Monday night, the 8th of July, about a week from now, is my new weekly stock pick service, where I'll be sending out my latest stock pick every Sunday morning, along with reasons why I'm buying it, and I'll be making the actual trade in my account the next day, so you can follow my real money account, my $1 million challenge. And if you want to make sure you're notified about that and receive the discount offer, then head on over to my website, clickcapital.io, come to the daily review page, and then enter your email in this box here and subscribe. Then you'll be on my email list, and you'll receive notification when my new stock pick service is open, along with the coupon code to save 40% as well for the first week only. And so after yesterday's video, I got a bunch of comments, questions, and feedback, both on YouTube, and I also received a lot of emails. Thanks to everybody who reached out to me. I know a lot of you are excited and looking forward to testing out this new service of mine. And so I thought I'd go over a few questions that some of you guys have had. First off, I made a small error with my target annual return to hit my $1 million goal in under 10 years. I'd entered the contribution amount as $2,000 a month because I'm starting off with $500 a week. And so I made the small error of just multiplying that by 4, and I entered in $2,000 a month. Whereas $500 a week multiplied by 52 weeks is $26,000 a year, divided by 12 months actually equals 2166.66. So the monthly contributions, I will be doing what I'm comfortable with. And again, this is not a suggestion that anyone else has to try and copy me or match me, nor am I expecting people to do that. Again, this is just an educational service where I'm sharing my picks along with my journey for people to learn and follow along. And so there's both bad and good news with my little small error there. First off, I'll have to contribute more closer to $415,000 over the 10 years, still needing almost $600,000 in profits. But the good news is it's lowered the target annual return from my previous 19.2% to 17.76%. And I know that's still a lofty goal. However, I believe it is possible, especially when investing in small caps. And of course, a lot will depend on market conditions in the coming years as well. We could easily have a few good years, 30, 40, even 50%. And of course, we should expect a down year or two in the annual percentage return. However, with regular dollar cost averaging, hopefully we don't have any actual dollar down years. We can still keep that equity curve growing every year. Also had some people say I've shared picks on the daily market review before, which I have done loosely. However, I want to keep the daily market review to what it is. It's a news show going over daily events. I want to keep my stock picks separate in its own private channel and as a formal service where it can be focused on 100% instead of just loosely talking about them on the daily market review. But don't worry, I'm still going to share ideas, other stocks I'm in. I've even actually got some plans on how to improve the daily market review. So don't think by any means this is going to take away from my daily market review. Someone wanted to know what the bear market strategy will be. And of course, there's likely to be a bear market at some point in the next 10 years. Plan to trade all the way through it. Drawdowns are just expected. And I know the reality is a lot of people will give up during that. That's just how the fund management industry really works. But given the fact that I can invest in over 4,000 liquid stocks, ADRs, REITs, and ETFs, there's always a bull market somewhere. Can always keep a diversified portfolio, especially when the stock market's downtrending. The biggest question I got was how much is it going to cost? And so I'm happy to reveal the pricing right here before the launch. I'm going to be offering two options, a yearly plan and a lifetime plan. With the yearly plan going to be sold for $440 per year, which actually works out to be less than $37 a month, and the lifetime plan lower than the cost of 2 years. However, if you've subscribed to this channel and also on my email list, or you've bought a product from me before, then you'll get an opportunity in the first week. As part of my launch special, I'll share with you guys a coupon code in which you can get 40% off both the yearly and lifetime plans. Like I said, for the first week only, taking the cost down for the yearly plan to $264 a year, which is only $22 a month. I think you'll find that a lot cheaper than most other memberships out there. And like I said, I believe I'm offering more value because I'm doing this transparently, trading the picks in a real money account the day after I give them with everything shown in the members area. Not too many other trading memberships you'll find that. They just overload you with information as a disguise of giving value when there's really no track record, transparency, and at the end of the day, it's just the results that matter. You don't need to spend 5 hours a day studying the markets to do well. That's just crap in my opinion. So in my service, there's no fluff, there's no filler, it's straight to the point, and I've made my goals and what I'm doing 100% clear and out in the open. No funny business, there's no smoke screens, there's no unrealistic claims or expectations. It's just straight getting to the point, and even better will be the lifetime plan. Again, less than the cost of 2 discounted years. So make sure you subscribe to this channel and you're on my email list by heading to my website, clickcapital.io, just subscribing to my weekly letter, and you'll get notified in a week from now when my new stock pick service is launched, along with that 40% off coupon code. And I'm really excited to share this journey with you guys. Trying to grow a real money account into over $1 million US in under 10 years, putting everything out in the open and keeping it 100% transparent, along with telling you exactly why I'm going to buy a stock. And as always, make the trades after I've sent out the picks, along with posting screenshots from all the fills straight from my trading account. I really got nothing to hide with this service. And I believe that's truly what's going to make it different from all the other crap out there. So as always, I hope you enjoyed this tutorial and found some value in it. If you did, I'd really appreciate it if you hit that like button and let me know you value these videos. And I'll do my best to keep making these tutorials for you guys. And I'm really excited to launch this new stock pick service on the 8th of July. So make sure you stay tuned in for more info on that. Thanks guys, and speak again soon. Cheers.